I want to introduce you to John Clifton. He's the Managing Director of the Gallup World Poll. And John, take it away.
Thank you, Jim, and good afternoon, everyone, and welcome to the Gallup Analytics Seminar, which is focusing on Gallup's Economic Confidence Index. With me today is my colleague who's been a member of the Gallup team for 20 years. She's also a senior editor of Gallup.com, and as I mentioned, she'll be here discussing some of the best findings from our Economic Confidence Index. So please help me welcome Lydia Saad. Lydia, tell us a little bit more about our index and what we're finding.
Okay, delighted to be here today, everybody. Thank you for coming. We've got a lot of material to cover, so let's go straight to the tape. I need to see the slides. If someone can bring those up in front of me.
Lydia, they should be available down there.
Oh, there we go.
You bet.
Okay. So we're here to talk about the Gallup Economic Confidence Index, and the first question you may have is, what is economic confidence? It's what you've often heard of as consumer confidence. That's what the Conference Board calls it. The Reuters Michigan Index, that has been around a long, long time, calls it the Consumer Sentiment Index. Gallup calls it the Economic Confidence Index. What it is, regardless of the name, regardless of who measures it, it's a broad measure of consumer psychology about the economy. We don't ask specific questions about spending habits or too much about personal finances. It's a broad confidence in the economic climate. And what we've learned measuring this for a couple of decades is that this mindset can be affected by multiple factors, both in the economy and in politics. We won't talk about too much of that today, but there's a lot of interesting things about what goes into consumer confidence. On the next slide, we just want to mention that what we'll focus on a little more today is what's the output of consumer confidence? Why do we measure it? Well, does it predict spending? That's the key question, and we'll address that a little bit today. And what else is it good for? In general, what people have looked at this for a long, long time believe it's a good summary measure of how the public reacts to key aspects of the economy. Some research does suggest that economic confidence provides independent information that actually helps improve econometric models, improve consumer spending. Other folks looking at it think, no, consumer confidence reflects things that are already known about the economy, the stock market, the housing market, the labor market, and that you can predict spending without knowing consumer confidence. But what you'll see is that even if it doesn't add independent information to what's already known, by itself, it's a very interesting summary of consumer behavior. So we can go on. Just a few nuts and bolts of the index to get us going here. Gallup uses rigorous nationally representative sampling, really the gold standard in telephone random digitile sampling in the United States. We measure all 50 states. We have a dual frame cell phone landline sample. We're up to 50% cell phone now. We do Spanish language interviewing. So we've got a highly accurate picture of U.S. consumer attitudes. Even if there was no other poll out there, and there are other very good ones, what we provide is as accurate a measure of public opinion about consumer attitudes as you're going to get. We have extraordinarily large sample sizes since 2008 that we've been tracking this daily, and that provides high statistical reliability. So the margin of error in our daily numbers that are based on 3 days of interviewing plus or minus 3 points. For our weekly results, that margin of error drops to 2, and for monthly results, it's 1 percentage point. So even if there's only small changes in consumer confidence, we have the statistical power to detect those changes, and that can be really important when you're looking for meaningful but small change. And then with the huge sample sizes we have, provide unparalleled opportunity to drill into the American public and look at different subgroups in different regions of the country. So that's just a little thing to whet your appetite about the nuts and bolts. We can talk more in Q&A if you have other questions. We can go on. Okay, so again, some of these things we just covered, but one thing I just do want to mention is that third bullet point there, that we have a strong correlation with Conference Board in Michigan since 2000. And also within our the daily poll that we ask about consumer confidence, we ask a bunch of other questions about politics and people's well-being on a whole range of aspects of their lives, so we can relate economic confidence to other measures that are out there. And next. So these are the two questions that Gallup uses to measure economic confidence. Very simple. How would you rate economic conditions in the country today? Excellent, good, only, fair, poor. That's our current conditions rating. And right now, do you think the economy is getting better or getting worse? That's our outlook measure. And we first asked these questions in 1992, 4 times throughout that year. We experimented with some other wordings after that, but by 1996 we came back to this wording. We repeated them on a regular basis from then until about mid-2000, at which point we standardized it as a monthly item that we tracked on our standalone poll. So from October 2000 through the end of 2007, we tracked this monthly. And then starting in beginning of 2008 with the launching of the Gallup Daily Tracking Poll, we've been asking it daily. And that's 350 days a year with a few days off for holidays. So this is how we calculate the index. We take people's answers to these two questions. We look at the net positive rating to each question. So for current conditions, it's the percent saying excellent plus good minus poor. And for the economy, the outlook question, the direction, getting better minus getting worse. We add those two things, divide by 2, and that's the index. So it's the average of the net positives. And here's an example from actually the week before last's index. We had an overall index that we reported of -8 is where this index stood. And that was arrived at by 3% of Americans saying the economy is excellent, 20% good, minus 30% calling it poor, and 43% saying it's getting better, 52% getting worse, divided by 2, and that was our index for the week. This is a good thing, very good thing to keep in mind as you follow the index, that the possible index range with that calculation is -100 to +100. We don't have to belabor this, but if you want to go back over it, you'll see that the highest possible score is 100 because that's what you'd get if everybody said the economy is excellent or good, and everybody said it's getting better, and you average it, and that's +100. If everybody said the economy is poor and getting worse, the average score would be a -100. But as you'll see on the next slide, the actual range that we've seen historically since we've been tracking this on a actually since 1992, of all of our measures combined, is a low of -65 and a high of +56. So the +56 came at the height of what we think of as the dot-com boom. Toward the end of Bill Clinton's presidency, deficits were low, economy was strong, stock market was soaring, and we had a current conditions rating of +66 and an outlook rating of 46, and the overall index was 56. Jump ahead to October 2008, or I'm sorry, back up, yeah, just to the right side of that graph. We're in the middle of the Wall Street financial meltdown in 2008, and you can see only 10% of Americans thought the economy was excellent, 60% poor, 88% getting worse, the bottom's falling out of consumer confidence, and the overall index is 65. So those are the range that we've seen high and low since we've been measuring this in 1992, and that's the framework you can look, have in mind as you look at our numbers. If you're looking for what's a good number on that index, well, 56 is a really, really great number. Anything above 0 is positive, net positive, and is good. Anything below is negative. And we'll talk later about what that means, what the political implications of that number are. But we can jump ahead now. This is a graphical illustration of our full trend, looking at monthly numbers prior to 2008 and weekly numbers since 2008. And again, you see the low was 65, the high was 56, and you can see that the path that confidence has been on since 1996, where it was positive for quite a long time, ran into trouble pretty much the day Bush took office. Confidence had dropped to negative, giving compounding problems in the housing market and other things. and struggled to stay above 0 during his presidency, and then plummeted with the Wall Street financial crisis in 2008, and has not reached positive territory yet, although you can see it's trying very, very hard. But this is a little engine that could not to date. Next slide. And this highlights some of the events going on during the peaks and valleys, mostly the valleys. And what you'll find rather interesting is a lot of these valleys are not economic driven, but political driven. The partial government shutdown, the budget sequestration, the federal debt ceiling debate when the U.S. credit rating was downgraded, the 9/11 attacks, just the global financial meltdown in 2008 drove us down to the 65. And there are other things in there we didn't mark that had to do with the Iraq War and so forth. So this is a measure that's very sensitive to political things as well as economic events. Really quickly on this is the long-term trend in the sub-indexes, current conditions, and economic outlook. What I find fascinating and what is, I think, important about this is that you'll see when economic times were good, when the overall index was positive, the current conditions rating is above the outlook rating. So when things are going really well, people acknowledge it and they tell us it's excellent or good, but they aren't likely to think it's going to get any better. They don't necessarily think it's going to get worse, but some people end up falling in the middle, volunteering it's going to stay the same. So that outlook number doesn't get as high as the current conditions number when the current conditions are positive. When you see everything kind of turned after 2001, the two lines were a little more similar, and as things got worse, at that point, economic outlook really plummeted kind of first, current conditions followed, but since then, the two have been sort of neck and neck with, at points, economic outlook outpacing current conditions. So people are hopeful that it might be getting better, but they don't really believe it's gotten better yet, and that's kind of where we are today. So one thing to look for as you follow these indexes is when you see that current conditions number rising significantly above the outlook number, things are on the mend. Why follow economic confidence? One sort of mechanical reason is that it actually provides an advanced indication of what the other leading confidence indexes will show. And you'll see on the next chart that if you just plot the Gallup Economic Confidence Index, the Conference Board's Index, and the Michigan Index for any period of time, we chose to report it since we've been doing routine monthly measurements, you'll see the lines are very similar in overall pattern. The ups and downs are very similar.
Lydia, on that point, why might it be helpful to an organization to know what Michigan or Conference Board are going to come out with before they come out with it?
Well, there are economists that predict every month what will Conference Board and Michigan be coming out with, and I believe the reason they're predicting it is because big changes in that index move the market. So if if there's a labor report at the beginning of the month that's terrible, and the markets are concerned how this is going to affect the economy, one important indication of that is how consumers are going to react to it. And if consumer confidence tumbles, the stock market often, drops significantly. So people who make money by looking for short-term changes on the stock market care a lot about what the Conference Board in Michigan are going to show in their monthly reports. And anything that can provide an advanced read on that, I would think would be pretty valuable. So, that's one reason people would want to know ahead of time. Now, this chart gives you the statistical correlations between and among the indexes. Just look at the top line, Gallup versus Conference Board. The two indexes overall correlate at a 0.82 out of a range where 1.0 is a perfect correlation. They move in lockstep every month. 0.0 would mean they move in opposite directions every month. So 0.8 is a very strong correlation. Anything over 0.5 is considered strong in general. Our current perceptions ratings, Conference Board assesses that with, I believe, 2 questions. We assess it with 1, but their index and ours correlate at about a 0.9. and their outlook measures and ours also very strong, 0.76. And you can study the other numbers later, but they're all very strong. These are direct correlations, our number to their number every month. The next slide is a little stronger, harder test of correlation. This is saying not just the direction, but the magnitude. So if instead of looking at the comparing the numbers month to month, you compare the change in the number month to month. So 1 month, Gallup's index moves up 20 points, the conference board moves up 3. All right, they're moving in the same direction, but they're showing a different magnitude. And this is what these numbers reflect. So lower correlation, still pretty strong, but we don't do quite as well forecasting the magnitude of the direction of change for Conference Board in Michigan as the overall direction. This is overall, though. I think if you were to look in depth, something we still is kind of on our to-do list at those times when there are big changes, those really important spikes or drops in confidence, that we're probably more similar in picking up those big swings. The next slide, again, I won't go, this is something I won't belabor too much. We could talk all day about this slide. But one of the great virtues of the Conference Board in Michigan is their longevity. These are institutions in the economy that have been tracking consumer confidence for decades. The Conference Board goes back to 1977, and Michigan back to 1946, really pioneered consumer confidence. So they have very long trend lines that are very valuable, but they measure it once a month. The Conference Board measures it at the beginning of the month with a mail survey that's sent to a random sample of people that take this at home and mail it back in. Michigan does it with a telephone survey conducted in the first 3 weeks of the month, with most of those interviews conducted in the first half of the month. And then both of them report their numbers at the end of the month. Michigan gives us a preliminary number in the middle, but their final number at the end. And so what we have found, because we're tracking it daily, is that the Conference Board number really reflects what happened at the beginning of the month. And they have told us in the past, I don't have an update of this from the last few years, but speaking with folks there, they mail their surveys to arrive the first of the month. People fill them out and mail them in. Most of their returns come in the first 10 days of the month. They do wrap up the following month with any that come in throughout the entire month, but the vast majority of those returns are the beginning of the month. So they are reflecting consumers' attitudes around the first 10 days of the month. What this graph shows is, or this data shows, is that if you look at beginning of 2008, in our weekly data, that second row there, we had an economic confidence index of -20. And throughout that month, we saw confidence tumbling at the beginning of 2008 from -20, the next week -28, -36, -44. Conference Board reported their number for January at the end of January, and it came in only slightly below their December rating. So even though the market was tanking and there were all kinds of economic problems surfacing, the markets were delighted. Conference Board came out and said, consumer confidence is holding up, because their number for January reflected the beginning of the month, which had actually improved a little bit from December in our data. They did not capture the extent of the fall in consumer confidence until February, which they report at the end of February as a 76, and that's when the markets reacted to the Conference Board. But as you see over on the far right, that was a full 5 weeks later after our weekly numbers showed confidence was tanking. And you can see this over and over in the comparison of our weekly data to their monthly number, that they are essentially looking in the rearview mirror when they're reporting the data. Now, it's still very valuable data, and there are months when things don't change and you're not missing anything. But if you're following both indexes, you're going to have more information than anybody else out there about what's really happening and completely understand their number. You're going to sort of predict what their number is going to be every month. You're going to understand what their number is. You're going to understand if their number is missing anything or fully captures what's happening, et cetera, et cetera. So like I said, we could go on and on. This is just one time period I'm showing you. We could look at this for every quarter since 2008, and I could give you examples of this kind of pattern happening over and over again. And I think I've spent too much time on that, so we're going to race through things here. Correlation with U.S. retail spending. This is a very straightforward, basic. Dark green line is the Gallup Confidence Index from 2008 to 2014, and you see a gradual increase after the dip in 2008. Monthly retail spending, adjusted for seasonality and all that, gradually increasing again after that drop in 2008. But a thing to, and so it looks like these are fairly well correlated. The thing I would just caution you about if you're looking at this sort of thing as you're using Gallup data is that retail sales generally always increase because of inflation, because of the constantly expanding population. And this just happens to be a time period when confidence was recovering after the collapse. So it's still somewhat, it shows some value in the index predicting spending, because you can see the index showed a drop in confidence in 2008, and so did spending. But this has limited value in terms of demonstrating the value of the index. Next slide becomes a little more interesting. Here we look at year-to-year changes, year-over-year changes in our monthly number. So our December number today compared to our December number last year, is confidence higher or lower? And we look at the same change in retail sales on a percentage basis. And so this is a much more difficult test of the correlation, and it removes the time element that is built into the two trends, that they're both correlated with time, confidence increasing over this period. We take that out of it and say, okay, what's just the magnitude of change? You see there is some correlation there, but it's not perfect. This is the overall index versus retail sales. Next slide, we look at the same retail sales data and just compare it to our economic outlook number. Now, a lot of people that look at the Conference Board and Michigan believe that the outlook number is the most important number for understanding the direction of confidence. In our index, it's not very well correlated, as you can see. There's only been a few times, specific times. Obviously, there are 2008, 2009 when confidence was recovering after the collapse, that the two really aligned, but otherwise few and far between in terms of strong correlation. Next slide. Now you can appreciate what you see here. This is people's rating of current economic conditions and retail sales on a year-over-year basis. And this is the real eye-popper where confidence really means something. How people feel about the economy today, not their hopes and aspirations and wishful thinking about the future, but what is their honest view of the economy right now. That is what appears to correlate most strongly with U.S. retail sales. Now this is coincident, same month to same month. If you were to do this analysis with some lags, confidence this month versus spending next month, I think the correlation can be improved depending on how you do that analysis with the data. But this almost, this really speaks for itself in terms of the power of this metric. All right, so let's shoot ahead. In addition to economic confidence being an important thing to understand to predict the other indexes and to understand spending, it actually has very meaningful implications for politics, for elections, for the president's approval rating. And we can go to the next slide, which I believe shows, so this is Economic Confidence Index in presidential re-election years. So the last 4 elections where we had a sitting president running for re-election. The first column shows what the Economic Confidence Index was the month before the election. And the next column shows whether the index was rising or falling, and the next one shows whether the economy was a salient factor at that time for the public. And so 2012 economic confidence was negative 11, but it was actually improving. Economic confidence, the economy was a very important factor for the public, and we know Obama won fairly handily by about 4 percentage points. Obama actually outperforms the, we'll go back to that slide just another minute. Yeah, Obama actually outperforms the economy compared to other presidents. Most other presidents, our analysis shows, would need the index to be closer to a -5 to win re-election. So for Obama, it didn't have to be 0, it didn't have to be in positive territory, even just slightly negative, and that was good enough for him to be reelected. For George W. Bush, when he was reelected in 2004, economic confidence was just barely positive. It was slightly up, or depending on the month, maybe slightly down from the month prior, but it was at least in that close to positive territory. But it was not an important factor. 40% rated the economy as the most important problem because the Iraq War was the much bigger issue in that election. Won re-election. Clinton, the only president in our modern history who ran for re-election with strong economic confidence, wasn't a factor for people because it was good, won re-election. Bush, the example, the opposite, negative economic confidence, getting worse, major problem, and lost the election. The next slide puts the economic confidence index and the popular vote margin for the president in a scatter plot, 2 different axes on either side, one for each index, but you can see how closely they align. And the dark green is the popular vote for the incumbent president. And you can see how close that is. A little bit of separation for Obama in 2012 because he outperformed the economic confidence index compared to other presidents. Next slide. Looks at the same thing for midterm elections and the president's party. And I won't go over these numbers, but if we go to the next slide, you will see we're looking at the House, the number of seats gained or lost for the president's party in Congress in that election, and what economic confidence was going into the election. Not as strong a correlation, but still pretty good in most cases. 2002, the two were not correlated because of the Iraq War. 2014, not as correlated as other years, but certain years like 2010, they were almost the same, and you can see 2006, 1998, and to a lesser extent 1994, pretty close. Okay, next slide.
Lydia, before we move on, those were highly political questions that were being asked, and from my understanding is the economic confidence and political questions were asked on the same survey instrument. Do you have any concerns about a context effect that the parties that are in office get higher, have more confidence in the economy at that time, and then it flips?
Well, we do know that people's answer to how is the economy doing is highly correlated with whether they share the party of the president. And so right now, Democrats are more positive about the economy than Republicans. But that wasn't the case during President Bush's term. And in fact, we have a trend chart at the end of this I can show you that shows the exact moment that everything flipped. So Republicans were more confident under Bush, and the following month Obama takes office, and now Democrats are more confident about the economy. We do measure these things. We have measured these things on the same survey instrument where there could be a concern about, well, I've just told you I approve of the president, so now you're asking me about the economy. I think I better say I like the economy. But even when we separate those two measures and put them on different instruments, we get the same answer. So we feel confident that what we're measuring is robust. But good question. So when and where do you find our news reports on economic confidence? How can you follow it? I'm going to start from the high-level view. We put out monthly averages at the beginning of every month on a routine schedule that's available on the website in the economic calendar. And here you see the monthly numbers moving around. Again, this very low margin of error, so most of these changes are significant. And because we're aggregating 15,000 interviews over the course of a month and spanning different time frames, the range for this is a high of -7 and a low of 52, a little narrower than the range based on standalone polls or the weekly average. So that's the monthly picture. And then next slide, we go to the weekly averages. So a little more choppiness, same basic pattern. a little broader range, -65 to -3, reflecting the fact that a weekly number can move more than a monthly number, or that a weekly number might capture a real rally or plunge in confidence that's corrected the next week. So a little more movement on this. And then the next slide is looking at our 3-day rolling averages since 2008, and a lot more choppiness, but same basic pattern. So you have all these options for how you follow confidence. Over the long haul, they're both going to give you the same picture. It just depends how much detail you want. Are you interested in how is the public reacting on Friday to market changes that happened during the week or the prior week? You might be looking at the daily numbers. If you're interested in how did the election affect consumer confidence, you might wait for the monthly number and everything in between. So just to summarize, we have a 3-day rolling average. We post this daily at 1 p.m. on Gallup.com, and it's based on approximately 1,500 national adults. Now, folks that subscribe to daily analytics receive actually the daily data, not even the 3-day rolling average. You receive the daily data 2 hours earlier than that each day, and that's an even finer gradation of the data than we report, but that's available on Gallup Analytics. The weekly averages, where our weeks go from Monday to Sunday, we roll up 7 days on that basis. We crunch the numbers on Monday, and we report them out Tuesday morning as part of a Gallup.com feature article that summarizes the data, provides a little context around whatever was happening in the economy or politics that week. And those are based on approximately 3,500 national adults, and that's heavily promoted to the financial media and is on the Bloomberg Economic News Calendar. So that's a metric that's really building in use and coverage. And then the monthly average we report on the first Tuesday of each month, again in a major article that summarizes what went on that month. And then at the end of the year we report, annual averages are available for a U.S. population on the national adult basis, but we also break it down at the state level and report that as part of a State of the State series where we review a lot of metrics at the state level. So if there's no questions there, I'll wrap this up with key information to take with you today. One, economic confidence is a really valuable metric to follow for many reasons. It's even if it's not adding independent information to what econometrics that are just drowned in data every day and do all kinds of forecasting, they may be able to figure out what's going to happen to the economy with super complicated economic models, but the American consumer summarizes that with their consumer confidence. They're taking in all that same information and they're spitting out their gut reaction to how's the economy doing, and that, as we've seen, may correlate very strongly with their spending. And as we saw in the difference between people's perceptions of current conditions and their outlook, I think the key thing to watch really is that current conditions number. Both the overall index should be moving into positive territory if we're in recovery, and as that happens, I would look for the current conditions number to get stronger and to finally exceed people's outlook. We want the economy to get better than to fulfill their hopes, basically. And then just back to that, the last point I'll just go over is that what makes Gallup unique in the world of providing consumer metrics that measure this psychology. We're all, as I said, we're all kind of measuring the same thing. And it's a very robust measurement in terms of you can ask it almost any which way with a different combination of questions. You'd be shocked if you saw how different the conference board questions are from the Michigan questions, and then our two very simple questions. But the correlations are so high, it's tapping into the same thing. What we think that we provide to supplement the important value those two metrics offer is the timeliness. The daily number is in near real time. The weekly number is keeping you up to date with all the major changes in consumer psychology on a routine basis. and then the monthly numbers are very useful for long-term analysis that can be done. But I would say that that weekly average is the just right frequency to watch if you just want to watch one number. And that if you're interested in predicting Conference Board in Michigan, the first week of the month is the one that predicts the best. So we can stop it there unless you want me to continue with a few post-election insights, John?
Well, Lydia, maybe just a few questions, and obviously we encourage all of the folks that are joining us online to shoot any questions that they might have to Lydia. But Lydia, just a few questions on what you've presented so far. The trend that you had in terms of our overall economic confidence that spans since we started collecting, it would appear that Americans' attitudes toward the economy are very reactive in terms of various events. Do you think that's true, or is this a leading indicator for something?
Well, I think it is both. A lot of those real troughs that we saw in confidence that were associated with political events were very, as you say, very reactive. You know, we didn't necessarily see spending collapse during the fiscal cliff or during the budget shutdown. But I think politicians are very worried when that happens, both because they're worried that the behavior might follow the attitude, and because they know there's a political backlash against it. But in terms of consumer spending, yes, it's reactive. You know, in essence, they're reacting to everything. But the question is, does their mindset affect their spending in real time, or is it predictive of their spending? And I think that's a very difficult question to answer. It's one we're still exploring, and it depends on what time frame you look at. But I think we're getting to the point that yes, I think that there is some predictive nature of spending. So if we know it's correlated, we know in real time it's correlated, but it may lead spending by anywhere from 2 to 3 or 4 months during some periods if you go back and analyze the data.
Now, you've mentioned two of Gallup's economic metrics. One is economic confidence, the other one is spending. What else is it that we're measuring, and how else can those things be used in terms of analytics?
Right. Well, that's a webinar for another day would be to talk about all of the metrics and how they interrelate. But so we have confidence in the economy. We ask people their daily spending. So we ask them directly, how much did you spend the day before on basically discretionary items, not including your a major purchase like a house or monthly bills. How much did you spend the day before? And that corresponds very nicely with consumer spending. Fortunately, that's the goal, and it does. And that's helpful because again, people are interested in knowing ahead of time how consumer spending is going instead of waiting a month for the Census Bureau to tell us what happened to spending. You can sort of see in real time what the spending trends are based on our Gallup Daily metric. And we see our Gallup Daily metric in spending correlates very strongly with the economic confidence. We also ask the general public every day about their employment. So we measure, we produce an employment figure that's comparable to what the BLS reports, and then we go beyond that and we measure underemployment, which is almost double what unemployment is, and then we measure payroll to population, an estimate that we think is one of the more robust indicators, which is what % of the overall public is employed. It takes out all of the problems of looking at who's in the workforce, who's dropped out of the workforce. It's a nice clean way to know is the labor market improving or not. And yes, all of these things are interrelated. And with Gallup Daily Analytics, you can do that. You can do all the cross correlations and then compare each of those with external metrics. A lot of power there.
Are we learning anything historically about how people feel about their local economies as opposed to the national economy?
That's not a part of this index. It's something we ask about separately in other surveys. We did a state of the state survey let's see, in 2013, we did a State of the State survey where we polled in all 50 states, and we asked them about their own state's economy, and then we could compare how they rated their state economy to how they rate the U.S. economy. And they're highly correlated, but there are some differences, particularly in certain states like North Dakota that's so off the charts about their own economy, and they recognize the national economy has problems. But that's actually not something that's part of Gallup daily tracking on an ongoing basis.
Great, thanks. Well, Lydia, do you have any closing thoughts on this? It looks like we don't have any additional questions from our chat board.
All right. Well, I'd be happy then just to close with, if you want to go to the next slide. Since we did just finish an election, one thing people have asked me is whether the election impacted consumer confidence or economic confidence, in particular with the Republicans taking back control of the Senate. Has there been any shift in the political dynamic? And what you see here is monthly averages of economic confidence by party ID. The dark green line is the Democrats, more confident than independents or Republicans. Republicans are on the bottom. And we just saw a very small shift between the October average and the November average in the confidence of these groups, with Democrats' confidence dipping ever so slightly, independents rising. I think it was about 6 points. I can look in the next slide exactly what that rise was, and Republicans rising about 4 points. So not much impact from the election, but possibly a little bit, with Republicans becoming a little less negative, Democrats a little more positive. And we'll see in January if that pattern stays the same or if things are going to spring back to where they were.
Okay, great. We want to thank you for joining our webcast today, and let you know if you have any questions. Lydia, what's the best way if folks had questions offline and wanted to reach you? Is there a way for them to do that?
Yeah, I can be reached at Lydia, Lydia_Saad, S-A-A-D. It's like the car, but with a D, at Gallup.com.
Excellent. We want to thank you for listening today. Of course, you can get a lot of this information is available out at our website. Just head out to Gallup.com, and we'd love to interact with you that way. Thank you.